Beth's tweeting. All right, welcome everybody to the Rhode Island Business Competition Find Those Funds workshop. Tonight is March 2nd, 2023. And tonight we are bringing back one of our popular workshops. Actually, not one of, we are bringing back our most popular workshop called Find Those Funds. And we are truly excited tonight to have such a distinguished panel of experts to provide information on the resources that are available to entrepreneurs. Our panelists will tell you a little bit about themselves tonight, but while I have the opportunity, I just want to thank our three panelists, Mr. David Hemenway, president of the Angel Nest, Thorne Sparkman, managing director of the Slater Technology Fund, and Tom Sperry, who's the co-founder and managing director of Rogue Venture Partners. So before we jump into the panel and begin, just a little bit of housekeeping. I want to mention our sponsors, which include private companies, service organizations, public agencies, colleges and universities, banks, investors, and most importantly, former competitors. These organizations provide ongoing support and commitment which enables the competition to function year to year, which I think we're going on 20 years now. And this allows entrepreneurs to build a business framework to transform their idea into reality. Since we were formed in 2020, we have over 50 previous competitors that are continuing to make a huge impact on economic development here in Rhode Island by growing and expanding their businesses, hiring employees, buying from suppliers, and service providers. In addition, I want to acknowledge one of our partners tonight, Venture Cafe, who is producing tonight's event. Additionally, I'd like to mention Bryant University, who's our social media team, and they will be spreading the word about the competition and tonight's event through all our social media platforms, including Instagram, Facebook, Twitter, and LinkedIn. And Beth would be deeply disturbed if I did not mention that applications are being accepted now for the Rhode Island Business Competition's 2023 program. The deadline to apply is March 27th at 5 p.m. and the sharp, Beth shuts it off at 5 o'clock. The application requires some time, so I encourage everyone to visit our website as soon as possible if you are considering entering. And the website is www.ri-business.com. Okay, now I'm tired. So we're going to jump into the panel. The way it's going to work is we have our three panelists. I'm going to ask them some questions that we've pre-selected. And as we move on throughout the presentation, towards the end, we'll take some possible questions from the audience if we have time permitting. So before we jump into the panel, I'd like to introduce immediately to my left is Thorne Sparkman, Managing Director of Slater Technology Fund. Immediately to Thorne's left is David Hemenway, President of the Angel Nest. And to David's left, way down there is Tom Sperry, co-founder and Managing Director of Rogue Venture Partners. So I'll start with you, Thorne, because you're a celebrity here in Rhode Island. And give us a quick 30-second intro of yourself as well as what Slater Technology does.
Okay, sure. So I have been here in Rhode Island for 23 years, investing in local technology companies. Before that, I was an internet entrepreneur starting on the West Coast and moved back here. But for most of my time, I've been an investor. I'm the managing director of the Slater Technology Fund, which invests in Rhode Island. And then I'm also a managing director, along with Bob Chatham, raise your hand in the back, Bob Chatham, from Right Hill Ventures, which focuses on university born technologies. So a little bit larger checks and all technologies coming out of universities. So a couple decades doing that. And those are the hats I wear. What else is pertinent here? We've invested $50 million in 150 companies over that time. We focus on life sciences, software, and energy-related technologies. With that said, we look at whatever entrepreneurs bring to us and try to figure them out. It just might take a little longer if it's not in one of those three batches. And we focus on things that can be really big companies. things that can have $100 million in revenue and be acquired for a lot of money, solving big problems in big markets. That's pretty common, but it's an important filter.
Thank you, Thorne. Great. And next to Thorne is David Hemenway, president of the Angels Nest. David, could you share with us 30 seconds about yourself as well as the Angel Nest?
Be happy to. Nice to see everybody. My day job is a sales and marketing consultant, along with an angel investor. I am a member of the New York Angels Investment Group, invested in 23 different startups and funds. New York Angels is about 150 investors from all different walks of life. We're told we're one of the most active angel groups in the world. We invested about $17 million last year. And I started the Angel Nest actually during COVID to help founders and funders find each other, because that was difficult when you couldn't have meetings with anyone. And it's kind of morphed into this whole really fun thing that allows startups to tell a lot more about themselves than you can tell in the 10-minute pitch that we ask you to do when you come into an angel group. So it's been a lot of fun, and we're always looking for great stories. So if you are a great story, or if you know a great story, theangelnest.com is the website. Love to hear from you. But before all of that, I started my first company here in Providence a long time ago. And so it is wonderful to come back and see, I'm still a part-time resident of Rhode Island, by the way. No one ever really leaves Rhode Island, from what I understand. And it's great to see the incredible ecosystem here and the startup mentality and, you know, frankly, what these two guys are doing to promote everything. I started my first company right out of college. I went to Curry College right outside of Boston. I thought I should go to Brown University, but there was nobody at Brown University who agreed with that. So I ended up going to Curry. It all worked out. It was great. Thorne actually asked me to be on a panel at Brown a couple of years ago. And they said, "Well, you came all the way from New York. Thank you very much." I said, "Listen, I've been waiting for an invitation to come to Brown University since 1979, and I was not going to miss it." So great to see what's happening here, and really thrilled to be a tiny, tiny part of it, and always happy to help in any way I can.
Thank you, David, and welcome. This is your first panel with us. We hope it's memorable, and we'll try to control Thorne and Tom as much as possible. And Tom, I actually can't see Tom. So Tom, how about yourself? Could you give us 30 seconds about yourself as well as the Rogue Venture Partners?
Yeah, sure. So thanks for having me. So Tom Sperry, founder, managing partner of Rogue Venture Partners. We're an early stage seed fund. I founded it about 12 years ago in Portland, Oregon. Since then, we've grown, and now we're investing out of our fourth fund. And our thesis is to look at undercapitalized cities. So we try to stay away from deals in San Francisco, New York, Boston, but we look at tier 2 and tier 3 cities like Portland or Nashville or Providence. And we now have offices in Portland, Austin, and I grew up coming to Jamestown in the summers, and now moved back here. I guess I've lived here for 3 or 4 years now. So we've got the Rogue, our main fund, which, like I said, we're investing out of our fourth fund. We've one of our larger investors is the University of Rhode Island's research center. So that's been a great partnership. And then we've got the Rogue Women's Fund. So for every $100 invested in VC, less than $1 will go to a woman founder. And so we started the Rogue Women's Fund 3 or 4 years ago, and now we're investing raising and investing out of our second fund for that. And that's run by a woman out of who was previously at Nike, who ran technology there. And that fund invests in women CEOs and founders. We're a pure tech fund. Very much the same thesis as what Thorne was saying. We look for big ideas and great founders. Yeah, and we've started investing here in Rhode Island. We made our first investment a year ago into Points, which is a Brown, two young women out of Brown, doing ways for micromobility. And yeah, it's great to be here.
Great. So thank you all. And, you know, I would be remiss. We're the steak. That's really the sizzle. So please allow me to introduce myself as well. I'm Anthony Mangiarelli. I'm a partner at the CPA firm KLR here in Providence. I'm one of the co-chairs of the Rhode Island Business Competition. And as I keep moving closer and closer to the crowd, I want to introduce my other co-chair, Peggy Farrell from Hinckley Allen law firm here in Providence, as well as our illustrious executive director, Beth Cotter, sitting next to her. And we wouldn't be able to make this all possible if it wasn't for all the folks that volunteered their time, including Annette. Thank you so much. Annette's in the crowd. Rhode Island Bio. So let's kick it off. Let's jump right into the first question. And I guess I'll throw it to you, Thorne. How should an early stage entrepreneur decide which type of funding to pursue?
Okay, that's a good question. But so you have to kind of ask yourself, what is the potential of your venture? So we talked about, gosh, can you get to 100 million in revenue? Can you be sold for $1 billion? All of that harkens back to what kind of return does the person who's writing checks want to get? So you can look at the size of a firm and kind of guess at how big the checks they write are, or you can just ask them. And everybody wants to make 10 times their money. So if someone buys a quarter of your company and you end up selling it for $100 million and $25 million comes back, then they would only be able to invest 2.5 million and still get 10 times their money. So that's maybe a sort of quick math problem, but you have to think from their perspective, what they want to put in, what they want to take out, and can a success from my company support their goals, right? So I guess that's maybe the most basic premise, is to understand what they want. And all these people want 5 to 10 times their money, if not more, right? Because they're hit-driven businesses. It's not that other than these guys, the superhuman investors, a lot of us whiff on half the investments. So the other half have to do really, really well, right? Really, really well to have a compound, return. So everybody wants to make 5 to 10 times their money. And you have to make sure that a realistic view of your company supports that, the market size. And also it's kind of a superhuman task, right? Because you're starting at zero. Maybe not everyone is starting, but you're probably starting at a product, but 0 customers and 0 revenue. And you have to do all that superhuman growth in, I'll let these guys say, but 5, 10, 12 years. So it's really impossible, honestly, right? It's not actually impossible, but it's against all odds. So that would be a way of thinking about it. Now, there are lots of different investors for different types of things, but the size that the investor can realize is one big piece. Maybe I'll stop there.
Thank you. I don't know what question Thorne answered, but we'll kick the same question over to David. Good info. How should early? He's going to answer the same question.
Yeah, but I don't remember the question. So he's going to.
Yeah, I'm trying to think of it now too. How should early stage entrepreneurs decide which type of funding to pursue? We talked about angel, VC, other types of funding sources. I did.
So I think it depends entirely on what you're doing, right? And what kind of business you're doing. And certainly, as Thorne said, what the potential is. I mean, what we most often see at New York Angels is companies that have raised a friends and family round. So they have built their product, whatever that is. They've gone out and they've done at least some beta testing, hopefully some real live customer testing. And they're coming to us at somewhere between $5 to $10 million valuation with some annual recurring revenue. And they're looking to go to market. So that's kind of our specialty, right? So now you want 10 million bucks because you've decided, you've figured out what the niche is. You figured out what you have to do to get there, and you need to hire these salespeople or these engineers, and that's really the key. So that's, at Thorne's level, frankly, and VCs, it tends to be a much higher bar, but much below that, you're really looking, I think, to find an investor who is really interested in what you're doing. So the secret that I've discovered is that at the very, very early stage, this is not really about money, because the investors aren't making very much money for a long time. It's really about finding the investor who is interested in what you're doing. And there's a lot of information about that. You can go on the websites. We all talk about what kind of investments we make. You can go on LinkedIn and you can find out what their particular specialty is. So a founder who is interested in building something in the advertising market, which is where I made my living, is a lot more likely to interest me than somebody who's doing a medical device, not because I'm not interested in a medical device, but I know I don't understand it. So what I would do is call the guy who does medical devices. So again, a very long way of saying kind of depends.
Tom, you got to rescue us here.
I mean, my feedback to entrepreneurs is, one, do you even want to take someone else's money? Right? So that's number one. Once you take somebody else's money, you're giving up part of your company, you're giving up some sort of control. And then once you make that decision on whether or not you want to take outside money, you then have to think about, what type of money do you want to take? Is it going to be venture because that has strings attached? Is it going to be angel because that has strings attached? Is it going to be friends and family? Is it going to be a loan from the bank? Is it going to be a grant? So there's lots of different types of funds you can take, or you can, bootstrap it and do it on your own with your own capital. So it really just depends on what type of entrepreneur you want to be, who and what type of capital you want to be, because not all capital is equal, who you then want to partner with, because not all partners are equal. And then once you've made that decision, how are you going to work as a team to accelerate your business and grow and be successful, and have alignment on, how you define success.
So can we stick with something there, Tom, that you mentioned that's interesting? You mentioned there's strings attached depending on what type of funding you take. Is it possible to share some of the different strings that are attached to the different funding sources that you're aware of?
But yeah, I mean, look, I'll just talk from a VC perspective, right? I mean, once we've invested, our expectations are that you're going to grow the company and have some sort of liquidity event where we will see, 10, 50, 100x, hopefully, and not a zero. And so we will work together to do that. But at the end of the day, I own part of your business, and our teams and other investors' expectations is that we're going to figure out together, hopefully, how to grow that business. That being said, if you don't execute well, we have the opportunity to replace you, or we have things in our documents that will give us control of how the company is run if it's not going in a way that we think is the right way. That being said, that's not very, that's rare for us to, do that kind of, pull those kind of triggers there. But, our goal is to work closely with the entrepreneurs and have alignment and grow and be successful, right? But again, once you take somebody else's money, they own part of your business, and there are serious strings attached. You become a fiduciary, right? Your responsibility is to your shareholders, first and foremost.
Can I say some other strings?
Well, I was waiting for you to jump in.
Okay. So first of all, the documents that venture capitalists use to invest in your company, they've tried to standardize them, and they're standardized by a group called the National Venture Capital Association. And I was talking to one of the guys who does those documents yesterday. You can look those up on the internet. So if you want to go download the documents and read what strings are attached, you can do it. So you can read the Delaware Charter, which is kind of the rules of the stock you will sell. And one of the strings is that the venture capitalist gets his money back first. So if we put in $1 million and your company sells for $1 million, we will take that $1 million. It's just kind of how it works. The last guy in. If another investor comes in after that and puts in $5 million, he'll take the first 5 and we'll take the next 1. And if there's any left over, it goes to you. So that's one of the rules. And that's written right in there. You can see that. And there's kind of low, medium, and high. Sometimes they want just their money back. Sometimes they want it back with interest. Sometimes they want it back and then they want a part of your company, but it's all written down there at nvca.com. They typically want to be on your board of directors, and the board of directors does a couple things. Not, they always vote on your budget and they hire and fire the CEO. So once you have 2 or 3 of these people on your board, and you can read the document, it's called probably the voting agreement, and it'll say, we put in this money, therefore we will elect 2 of your 5 directors, and those people decide whether you work there or not. So your very future at the company, wait a second, I started this company. No. Your future at that company is based on, do 3 of your 5 bosses still want you to work there the next year? So that financial one and that, do I still work at the company I started? Those are 2 strings that I would point to, and the rest of them are written in those docs if you really want to look them up.
Things are negotiable.
So I'd like to just bring up the other side of this, which is at an earlier stage in our angel group. Founders often come to us looking for investors who can actually help them build the company and who can become advisors and who can actually make a contribution beyond the money that we put in. And if you're wise about how you pick those people, they can really be transformative. So we have a guy in our angel group who was the vice chair of Vivendi for a long time and had a lot of knowledge and a lot of contacts inside the gaming space. And he's been able to transform a couple of our investments. So, at a very early stage, I think, what these guys are talking about is when you're taking in, $1 million, right? $2 million, $5 million, when you're just getting off the ground, because angels are really into it because they're interested in what you're doing and they really want to participate. So, you should think about how you can use that to your benefit.
Say the same for VC. We're into it. Going to bet on you, and they're going to help you grow. And out of legwork, they're doing like as you would do any individual.
So that's pretty interesting. So essentially what we're saying is when you start a business, you're bootstrapping it, you're putting your own funds in, then maybe it's friends and family. And then when you go out and you get serious about raising funds, probably angel groups to find some people that are individuals. And then as you determine that you have scalability, maybe you go the VC route instead of continuing on the angel route. Is that a good way to summarize it? Sorry?
Yeah, that's one way to go. So the best money you could ever get is from your customers, right?
Yes.
So if that would be choice number 1, right? If you could possibly make something and sell it, without raising $1 jillion, that's way, way better. So I don't know if you can do that if you're making a cancer drug, right? Or a medical device, but I would add that to the list. But your stratus are correct. The people who love you first, and then the angel investors who are interested and curious, and then the larger investors, I would say. Sorry, Peggy.
Pre-sale or
Yeah, so Kickstarter is a place where you put your idea up there and you say, here's what it's going to be like, or here's what it is like. And you ask people to pre-buy it before it exists. So they don't really end up owning part of your company. They end up owning one of your products once it's made. So I would call that a brilliant way to do it if you can do it that way, because it promotes your product and you don't give away any of your company. I'd say it's better for, groovy new kind of gadgets than for cancer drugs, right? Because everyone's like, "Ooh, I'll try one of those." But it's a great idea if you can make a glossy video of it, and some people are really good at it. Yeah.
Well, you don't execute well.
Yeah.
Something else you should definitely check out is a wonderful thing called non-dilutive funding, which is, really comes to grants and things like that. So we have a relationship with a group in Canada that funnels a lot of their startups. They all want to come to the US because of the market size, and they fund a lot of their startups through us. And those companies get tremendous amounts of money from the Canadian government. It's just incredible. I mean, millions and millions of dollars, though. And in fact, sometimes as an investor, it's almost a problem, because here's a company that got $8 million for doing nothing. And, there hasn't been a tremendous urgency necessarily to make it profitable, which is okay. But as an investor, you have to make a determination as to whether or not that's going to be a good investment. I talked to somebody the other day, actually, who has a sleep company helping with sleep. And they got $1 million from NIH, right here in the US. So, that's a wonderful possibility. And you can also get really creative. So when I started my company here, I had no money, and I funded it on $5,000 that I borrowed from a client. And, there are all sorts of things you can do. There was a company I was talking to last week. They have a mobile advertising company, and they've been kind of working for hire, and now they want to establish routes, that would be there every day and try to sell like an advertising network. And they were trying to raise money for it, and there's just no way anybody was going to give them money to do this. But I said, he said he only needed 3 fleets of trucks in order to, establish this route. And I said, why don't you talk to the owners of the fleets about sharing revenue? And he said, oh, that's a great idea. So I'll keep you posted on how that goes.
So some interesting stuff there. I would agree with Tom that the crowdfunding, I've seen companies, they start off fast, and then when they try to go do that next round, and some of the serious investors look at it, it's a disaster. The cap table's a mess. The audit, I can tell you, is not fun. But David brought up something that's interesting, is the non-dilutive funding, government grants, National Institute of Health, NIH, the SBIR fund here. Sorry. DoD, Department of Defense. So that is a way to raise funds where you're not giving up equity. And, there are still some strings there. I can tell you with that. So be aware of that. I'll mention Rhode Island Commerce Corp here was here tonight, quasi-government agency here in Rhode Island, that they have different programs tonight. They were bringing up a $50,000 grant for research and development, which is pretty important when you're up and running. But I think one thing that's interesting that I think about this is, how does an investor find you? It's not like you have billboards up, you got your websites, but you talked about finding the right investor, finding the right person to invest in your company to work with. How does somebody find the right person? So I thought, how would somebody, come to find you? And, besides the website, word of mouth.
Well, I hope I'm pretty easy to find, right? Honestly, you can sort of Google me or whatever, but so I'll say the way we look for investors is there are databases of people out there and exactly what they've invested in the past. And I use that all the time. So we use PitchBook is the one that we use. And entrepreneurs spend a ton of time figuring out what the specialty of each firm is and what the partner is and how much money they have left and what are the other things they've looked in. So that's the first stage of doing the raise, is writing down 100 names of people who could be the right firm and then going through and learning more about it and reducing it down to kind of 40. But that deep research in something like PitchBook, I find incredible. And by the way, that didn't exist when I was an entrepreneur. There weren't even, may date me, but there were not angel networks and an internet to look them up on, for that matter. But now there's no excuse for not knowing everything about the people you're talking to.
It's not as good. Crunchbase. It's free. PitchBook's got the best data, but something like Crunchbase. But the other thing would be to go up on, any sort of like TechCrunch or any of these kind of websites. And then what I would do is research the articles of companies that have just received funding and of companies that are in your kind of wheelhouse, and then see the investors or the folks that are writing checks. And then obviously there's LinkedIn and, other ways to do it. And then research where you are locally, about local funds, because there might be angel groups that are local that might be of interest. But like Thorne said, there's so much data out there.
Angel Capital Association, right on their front page, has, most of the significant angel groups in the country. And they all have websites, and they'll tell you what they invest in and who they are, and you can track them down on LinkedIn. I used to do a whole seminar on how to get to angels. And the thing to do is to once you get to the group, go to the individual, who's really focused on what you're doing. I mean, nothing wrong with sending in a blind application and email, but it could be a problem. Yeah. It's a whole lot better when somebody brings you in. Just is much better process.
I would say the best way to get to our group is to do research on the companies that we've funded and reach out to those CEOs and portfolio companies and really understand from them what it's like working with us, and come to us with a little bit of knowledge about who we are and what we've done and what we care about. And then try to get a warm intro through that or other people we know. For example, I'm not on LinkedIn. We've actually lowered the amount of data we put on the web right now, at least on our main site, just because we get so much inbound that's not relevant to us at all. And so we're trying to, limit the amount of BS that comes to us, right? So.
Interesting. I'm sorry, did you have a question? So I'll just ask the question so that everyone can hear it. Essentially, this is a valuation question. It's when you're an early stage company and you're looking to bring in an investor, how are you determining early on what a good valuation metric is? Because you know that if you've got the funding and down the line you're executing, you could be worth exponentially more, but early on that hasn't happened yet. It's just, how do you value what can be?
It makes no more sense than the stock market, actually. It's whatever people are willing to pay on a given day for an asset in comparison to what the other assets that they're looking at tend to cost. So if you roll back the last 6 months and look at the last 3 years before these last 6 months, I would say that valuations have increased, skyrocketed. So
Decreased. Went up, but the last 6 months have come down.
exactly right. Exactly right. So we look at companies, maybe the typical company on the high side has $1 million of recurring revenue when they come to us. And the last company that I invested in that situation was a $9 million valuation. A year and a half ago, that would have been a $15-18 million valuation. Today, we're looking at one that has a $7 million valuation on its way to 5. So usually the entrepreneur will come in and will pick a number and try to justify it. Obviously, without being unfair, our only leverage on the investment is really what we pay. And that's especially true for angels who are putting in $25, $50, $100,000, not putting in a lot of money. So what matters to us is how much of your company we can own for that amount of money that we're putting in. So I've seen great companies at $35 million, $40 million valuation. My $25,000 or $50,000 against that $40 million, in order for me to get a 10x return, that company has to go for $1 billion. That's not a great bet.
You can think about it from a dilution aspect where you're going to dilute on every round 15 to 20%. Would you guys agree with that?
I would say that investors always end up buying 20 to 30% of the company every time. And if you're not in that zone, you're probably swimming upstream. So nobody wants to buy 2%. They just don't. They just always seem to end up buying 20 to 30% of the company in each. His range was a little lower there, but that's my experience. I will say one other thing is that there is data out there again, right? So if you think about companies that are much bigger that have profits, you can get a multiple of how much the company is worth to the profits, right? So that's what stock market people do. They look at it, and I'm not sure what the NASDAQ trades at now, 20 or 30 times earnings. And they'll be kind of tightly in that range. There will be a multiple of enterprise to earnings. Startups don't have that. So it's revenues, and there's a wider range, but there's a multiple of revenues to valuation. So for people who are thinking about doing software things, you can get on the Bessemer Index. There's a website called the Bessemer Index, and they track all the public companies doing SaaS software. And you can see how those things change and go up and down. And it was, for a while there, 18 months ago, it was super high, like 30 times revenue. And now it's kind of back down to 4, right? But people track those. They know, okay, my thing should be 6 times revenue, or these things are trading at 6 times revenue. If you don't have revenue, then it's wackier, right? Because there's literally nothing to multiply the other thing by.
10 times hope. So another interesting problem for early founders is, you need $1 million, right, to build this thing that you want to do. And what's your company worth at that stage? So Thorne's in the 25-30% range. I would agree with that. If your company is only worth twice what you're trying to raise, you're giving away half your company right away, or 40% of your company right away. And even if you're a diligent founder and you're willing to do that, we're not going to like that, because if you get diluted again as you raise more money, sooner or later, you're going to end up with too small a piece of the company for us to be comfortable. We want you to have a significant stake of the company, because that's our best guarantee that you're going to perform. So that's why you really need to get some traction before you get into raising, serious money.
Let me say one more technique, because when I said, oh, what if my company doesn't have revenue? I saw a lot of heads nodding. So another thing you could do there is say, okay, right now I'm in Nowheresville, but in 18 months, I'm going to have $800,000 of revenue. And it's very credible. And no matter what you say, someone else will want to reduce it. But you can say, now I'm not there, but I'm going to have 800,000 in revenue in 18 months. So then I'm going to be worth 6 times the revenue. So I'll be worth whatever that is, $4.8 million. And let's say I'm worth half of that now. So you kind of project out to a future state and then come back to it. That's another way to get out of the kind of no data about me now situation.
So I'm just asking. Does it make sense to think?
Absolutely. That's what I was talking about. These are all comparables. What are other people's, value divided by revenue? Those are all comps.
Anything you can find publicly that you can look back on, and typically what you can do is do a 5-year projection and you discount it back based on different factors, success, possibility, interest rates, which have kind of played some tricks right now lately with valuations. So
that's just another math thing. So what I was saying was 4 times revenue next year. This is much more complicated, but
don't call an accountant.
But it's the same thing. It's math of revenue.
It's guessing.
He's not wrong. So the question is, how does the folks on the panel feel about the safes, which has become the newer, I guess, chosen early instead of convertible debt way to raise funds early on when you're pre-funded by a VC or a angel?
Safes have nothing to do with that question, to be honest with you. Safes were just created by the Y Combinator guys to make it easy to move a financing forward faster, because you can put in caps, you can put in valuations, you could do whatever in a safe, just like a convertible note. One issue that you have with a safe, if you're an investor, and we actually don't do safes because we ran into this problem when we did, is that with a convertible note, at least you have the opportunity to convert it and you have some sort of control as the investor. With the safe, it's very entrepreneurial friendly, and they have all the control. When we've run into issues where the entrepreneur basically used the money like their own personal bank account and didn't convert or didn't go out and raise more money and kind of did their own thing, we had no mechanism to, make a change to how our money was being spent. The reality is you can put those mechanisms in safes. Safes are just a legal doc that have nothing to do with valuation.
So our group will not invest in a safe, unless we write a side letter that essentially makes it not a safe.
It's the same.
For all of the reasons that he said. And I think it puts in timelines. So what happened was safes became very popular the last couple of years. Again, the last 6 months. And we're getting so many people requesting safes. We said, well, okay, how could we work with this? And maybe there's a way that we could, but just as we were kind of coming up with what that mechanism was going to be, the world all changed. And now we're just back to saying no safes. The other thing that might be helpful for you to know is there are tremendous tax benefits for investors who invest in early stage startups that go on to sell at a huge premium. Those benefits do not extend to convertible notes. And there's a 5-year waiting period if you're an investor. So a priced round is much more appealing to investors than a convertible note. My very first angel investment, we got a 2x in 2 years, which I was just ecstatic about. And then I found out it was all ordinary income because it was on a convertible note. This is how you learn the investment business. So that's one way that you can make it, more investor friendly. It can be a little bit more expensive to develop all the paperwork, But, you know, there are a lot of firms now that will help you with that and kind of take their money after you raise.
So for you, those of you that are wondering, a SAFE is a simple agreement for future equity. The accountants don't know if it's equity or debt. We still struggle with that, even though we say we don't. And what David is referencing, I think, is 1202 stock with a C corp. I just did a deal where if you are a C corp from the start and you hit certain metrics and then you sell, depending on the year that you were founded, the entire gain is not taxed. So these folks just walked away with $14 million with no income tax on it. Whereas, as David referenced, if it's ordinary income, that 14 million, you're walking away with 7 of it. So that's a big thing to understand when you're talking to your investors. And I think that's what we'll segue into is how, as investors, how do you know that somebody's serious about their company as well as growing the company? And when they first meet you, what type of evidence do you look at to know that somebody is a serious entrepreneur?
I kind of like to see if they've quit their last job sometimes. A lot of them haven't. I like to see if they've invested themselves. It shows that they're pretty committed to it. So those are 2 things I think about.
And friends and family, because the holidays are awkward if they fail.
Always nice to talk to early investors. This is one of the things we started doing on the podcast. We not only interview the founders, but we interview the early investors and sometimes the customers. Customers will tell you an awful lot, even though they're clearly, you know, hand-selected customers. But still, if you talk to enough people, you know, you begin to get kind of the mosaic of what the person in the company is all about. And, you know, it's just all about the CEO really and the team. So it's really, you know, diligence, right? When we see somebody who's been doing something for 10 years and is now going to raise money for it, you know, that creates a high hurdle.
Hey, look, I mean, being an entrepreneur is hard. So I've got all the respect in the world for anybody who's willing to take that risk, and whether we invest or not. So, you know, our job at Rogue is to bet on people. And so we try to really dig in and build a personal relationship outside of the check and really understand that their values are aligned with ours, and that their long-term goals, what they want to do with the company, are aligned with ours. And hopefully, you know, together we can make that happen. But, you know, with the amount of time we spend with people, we can weed out. We do a pretty good job weeding out when our goals aren't aligned. And you know, one of those things where we did a bad job was with that safe note, right? We made a bad investment, and they had ulterior motives or ulterior thoughts on what they thought about being an entrepreneur. And so we've definitely made our mistakes, but for us, it's about spending time together and working on a plan about what's going to happen after the money goes in.
I'll add one more, which is if they don't know something about the firm or me first, I'm pretty suspect. So if they sit down and say, well, tell me what you guys do, it's like, really, you couldn't get to the web before you sat down here, really? So I would not do that. I would go in really serious with an agenda and prepare the person. You can really sniff unprepared people really quickly.
Yes, do you have a question? So I think the question is, do you value the return on the investment so much that if you meet a company that you really think is a great partner, you would jump out as quickly as possible, or would you stay in because you really like being a partner with the company?
I mean, look, my job is to make my LPs a lot of money. So at the end of the day, as much as I like you and we're going to partner, you got to make me a lot of money. So that being said, you know, I'm very close with many of my CEOs, and we talk very often depending on the life cycle of their business. But, you know, I've got LPs that I have to answer to. And so that being said, it depends also on the kind of liquidity event that happens. Maybe we sell some stock now and believe the company's going to grow, or it's going to go public. And so we'll sell some now, whatever. It just depends. But you know, I mean, at the end of the day, I got to return a ton of money to my LPs. And so as much as I love our partnership, you know, it's going to end someday when you make me a lot of money.
Yeah,
I
I mean, there tends not to be a lot of discretion, right? Sales either happen or they don't. I mean, very often, you know, we're in a position to influence that. And, you know, we actually had a tremendous company that had a great offer to sell, and we all really discouraged him because we just thought that, you know, he could go so much further. And, you know, it's only been 2 years since then, but so far he has. So yeah, I mean, I think, you know, that's all part of the determination of, you know, what is the ultimate value. And as investors, you know, it's interesting, especially on the angel side, like we are, you know, if somebody owns 40% of a company and they sell their company for $30 million, you know, that's a big score, right? Our piece is 25% and it's shared among a lot of people. And maybe we invested at $8 or $9 million. It's a 3X, but, you know, we'd like to do better than that.
I show it and move on. Thorne agrees. You know, while we're on the cash out subject though, who's exactly, you know, because I think sometimes people don't understand who exactly is buying the company after you've invested it and scaled it up. I mean, we're talking strategics, private equity, going public. You know, what's typically happening? What are you seeing out there for the acquisition?
I haven't ever had a company go public, not for lack of trying, but it's never worked out. So it's usually another corporation buys it. We've also had situations where another really big investor comes in, like a private equity firm or a huge strategic investor, and sometimes they'll buy out other investors. So, but most typically the company gets acquired by another company.
So largest recent exits at New York Angels, one company was bought by Uber. One by private equity, several by private equity. That's probably the largest, I would say.
These guys said it.
Yeah.
We try to avoid those situations.
Those are those strings, right?
So one thing, we had somebody come into our group a couple of months ago, and he said, I want you to know how passionate I am about this business. I love this business. I'm going to build it up from nothing, and I promise you, I will never sell it. We said, thanks for coming in. Nice to meet you.
Sold it. They have rules that are built into the stock that says if you haven't sold it in X years, you have to buy me back. Those usually aren't good situations, but they do have rules like that.
So while we're on that subject matter, what are common mistakes that you see folks, entrepreneurs make when they're coming in and going through the capital raise process? What's the most common mistakes you see? Let's start with Tom.
I mean, I would say the worst mistake is one, I would say, I thought Thorne's comment of not being prepared when you're going and talking to investors. So not doing your own due diligence. That's number one. Two, I would say not understanding what you're selling and pitching and your financials, even though your financials are totally full of shit, but not understanding the mechanics behind them. I would say the worst mistake you could make, though, is just picking bad partners. And so not really being ruthless about, you're in a position to say no, right? That's a very strong position to be in. You can turn capital down. And I think not enough entrepreneurs understand that position, and they just take kind of any money that they can get. And from my perspective, there's good money and bad money, and you have to be really selective about who you're partnering with and why. And that might mean taking a lower valuation, but you're going to get the right partners that are going to help you grow and that are aligned with you, and help your business more than taking some crazy valuation. I was in a deal where an investor came in and gave they had just left a incubator, and the investor came in and said, "Here's a valuation of 20 million," which is completely irrational. They said, "We're going to not pay any attention to you until you hit these benchmarks. So here's a check. We're not going to help you at all. But if you hit these benchmarks, we know you're actually going to be of value to our fund, and we're going to help you then be successful, because then you'll be able to return, we've got 500 million under management or something." I told them that it's probably not the best investor for you. It's a nice check. You're getting great valuation, but they're adding no value. The only value that you're getting from them is when you hit a certain number. Otherwise, they're going to write you off and not think about you. They just didn't listen to my advice. They took the money and got zero value out of it. And it was actually negative value.
So I've started 5 of my own companies. So I understand founders who come in who are absolutely obsessed with what they're doing and completely inwardly focused on maybe their process or the part of their company that they feel so passionate about. And that's wonderful. But if you're coming in to talk to investors, you have to talk to them about what they're passionate about, not what you're passionate about. You literally have to almost get up, go to the other side of the desk and say, okay, if I were going to put my money in this company, what would I want to know about it? And that's where so many folks really struggle, because without that, investors, have a hard time writing checks. The other thing is, I think, you have to understand that we're making big decisions based on a little bit of information. Even if we spend 10, 20 hours with you, that's not a lot of time in the scheme of life. So everything you do, everything you say, we are taking and magnifying and making assumptions about you, your character. And so many of these things are, unforced errors. People show up late. They show up looking like they just, crawled out of bed. Their tech doesn't work. You want me to invest in your technology company, but you can't make your presentation work? Really? And those are tough decisions to make, because we all are late sometimes, right? So those are normal human things, and nobody wants to be a jerk and condemn them for that. But that's all we know about you. So it really helps to be prepared, as Thorne said, and make the best possible presentation you can, because a lot's riding on it.
I would add a couple things. Hyperbole is I just hate it. So if someone's saying we're going to be at this level and you just know it's not, and you just can't even discuss it, it's really hard, right? It's really hard. And if they say there's nothing like what I do, and you say, well, what about this? That's not exactly what I do. Ours is a little bit different. So I think being able to be really kind of reasonable and flexible and listen to that stuff, and not stick to the no, we're perfect, or we're unique, or we're going to be sky high. Those are pretty glaring mistakes, I would say.
I would say too, integrity matters in everything you do and say. And a lot of our job is to sniff that out really quickly. And so if you don't know the answer to something, please just say, I'll get back to you and get the answer. Don't lie or make something up when we can see right through it. Just integrity is mandatory.
So I think a good tip is to say there's no competition, and it is okay if you don't have the answer, to make sure you say, we'll get back to you, because you don't want to give the incorrect answer. At this time, let's open up to the audience. Are there any questions from the audience? I mean, I've got a whole list of them, but I'm sure people in the audience may have some things on their mind. Joe. So to repeat the question, I think you're saying, what are some things that the entrepreneurs can do to correct items before they get to the due diligence process?
Well, I mean, those are all very valuable. I was actually thinking of something else. So we had a company that came in, we were looking for esports investments, and we still are actually. And this company came in and they said, you know, it was a betting company, actually sports betting company focused on esports. And when we kind of peel back the layers, we realized they weren't focused on esports at all. They were focused on, you know, on fantasy. And they were going to be competing with DraftKings, which seemed like an entirely, you know, different set of it. But and then they came back and said, no, we'll focus on esports. It basically goes back to what he said about integrity. There is no substitute for integrity. And you know, if you're a business partner with somebody, there's so many ways along the road, you know, that can be a problem. So that if there's no trust, there's no basis to move forward.
I would just say there is no substitute for great counsel. So have a good startup lawyer who understands the startup ecosystem. There's a lot of great tools out there, like Thorne was saying, with the kind of documents and things like that. And also, I would also say the same thing for accounting firms and getting your finances in a row, in check. There's nothing worse for us as investors to kind of dig in and see that all the basics are screwed up, because as I say to our, you know, CEOs and my team, like, you got to get the easy things done easy, because the complicated things are much harder, right? So if you can't have your docs set up right, or your counsel doesn't know anything about a convertible note or being in the startup world or anything like that, you just got the wrong counsel. So there's a lot of things you could solve by having great people around you.
A bunch of the things you said are fixable too, right? So if you want to have, you know, we invest in Delaware C Corps just for, I don't know, a variety of reasons. But if you're not a Delaware C Corp, you can actually change that. The S Corp thing you're talking about, I've made that mistake. It's kind of fixable, kind of not, but it's like not the end of the world. Right? And it's not even really the thing that matters. I have had people say, well, so-and-so is, you know, is investing, or so-and-so has bought it, or so-and-so, right? Things that end up not being factually true, right? We have a deal with them. Well, it's kind of in the discussion, you know, it's not written down, it's not signed, you know, and is that exaggeration or bullshit or what? So, and I would say that those are worse, honestly, you know. I did one diligence call for somebody, and the person said, oh yeah, this guy is so great. That's why I hired him to be the CEO of my company. So the guy was CEO of two different companies, and he hadn't told me that. So like, he hadn't even prepared the person that he was sending my direction. So I would say that the technical things you're talking about that are kind of legal, they may not be great, but they are fixable. Whereas the hyperbole or the, you know, the integrity stuff that he talks about is less fixable.
I would say, if we shake hands, in my mind, it's a done deal. If you start negotiating after we shake hands, we're not doing a deal. And I can't tell you how many people are so stupid that are like, think that's a good idea. Or their quote unquote advisors are like, maybe you should go back. You're like, how much money has your advisor put in your company? 0? Well, you should go tell him to fuck off, because he totally just screwed your whole company. You know, I can tell you. Anyway, sorry for swearing, but
We did not pay the panel, Peggy and I, to talk about great attorneys and accountants, but you know, I equivalent to, if you have a heart problem, you don't go to a foot doctor. And we see it all the time. Tomorrow morning, Thorne, I am unwinding an LLC taxed as an S Corp with a ton of IP in it. So, and they want to do a capital raise. So yeah, sir, you had a question. So I think the question is, what's the right amount these days for a seed round, Series A? And at what point does it make sense to get the legal team that this is their specialty, the expensive legal team that this is their specialty? But hey, well worth it, because, we all know that if you make those mistakes, these guys may not pull the trigger.
Okay, well, the seed thing goes up and down. The average size of a Series A now is $8 million. It changes. It used to be 2, now it's 8. Seed is kind of 500 to 1.5, but those things change. What I would say is that if you're going to set it up so that if you're going to do it in this particular track, it's worth finding someone who knows how to do it. So Peggy knows the NVCA doc. She knows how to do that. She can look at a document and say, that word is not in the model doc. They can do that, right? She just does it over and over again. So it's worth finding someone who does that in the same way you don't go to a foot doctor for a heart attack, right? So any lawyer can create a corporation for you. And you could probably do that on the web. You can do that on the web. We do that on the web. But and you can change the one you get from a Rhode Island LLC into a Delaware C Corp, but it's almost not really worth it. It's like not that hard to do it the right way. So I would find the person who does those, and you can just ask. You can just ask them, hey, do you guys do this kind of thing that I'm trying to do, because I'm trying to set it up right? So the next question is, how much should you be spending on that? And that all the time too. But you're probably not even going to do it until someone says they're going to give you $2 million, right? So I wouldn't worry about it until someone's going to put up $2 million. Don't do something that has Series Seed preferred with the voting agreement and registration rights and all these kinds of things that you really don't really need. Does that answer the question? No.
There's some good
What's the
lawyers.
specific question? Tell me the specific question. So you should ask him what his startup package is, because often they'll, not to like jump in front of any, but they will say, look, tell you what, I'll do it for free until you raise $1 million, and then you owe me 20 grand. A lot of people will have that package. If you've sold a company before, they want to make sure they do your next one. And if you say to them, geez, I'm not sure whether I should go with Cooley or Goodwin this time, what's your startup package? They'll probably be something that they could do for you, which because they can do it pretty quickly. It's not that hard, even though they may, but you don't want to pay a bill that's $10,000. Okay.
Yeah, so I'm going to raise X, but I'm going to pay X to raise X. So I'm going to raise $1 million, but I'm going to pay 300 grand. Well,
You're gonna just go and negotiate, just go talk to them and say, let's put a cap on how much we want to spend, because we're going to be a partner for a long time, and I'm going to pay you a lot of money, and we're going to do this. And by the way, I'm going to do it again, and we've already done a deal, and just let's cap it at 50 grand or 40 grand and negotiate. And that's how you'll do it. 30 grand, whatever the number is you want.
By the way, I just wanted to mention for the person who is fortunate enough to be the winner of the competition, you get in-kind legal and accounting services.
There you go. So the gap in price is just, unbelievable. I mean, I've seen it done for $5,000. It can be done for $5,000. Ask your investors, because, investors who do this on a regular basis probably know someone. New York Angels, we have like 3 different levels of attorneys.
Yeah, but I have a lawyer right now who just offered a portfolio company of ours to do all their incorporation, everything you're talking about for free, knowing that they're going to get, well, because we send them a shit ton of deals, right? So, I mean, just talk with people.
Speaking as a lawyer in the room, you should be a little realistic. It's one thing for a lawyer who's got a long-term relationship with a venture capital firm to say he's going to do portfolio work for free because there's a stream of business that's going to make sense. One-offs are a little more challenging. But as I always tell people, don't be bashful about asking, negotiating. It's often hard because for the lawyer, speaking as a lawyer, it's hard because going in, you don't know how difficult, if you're representing the company, the VC guys are going to be, right? If everything goes smoothly, it's a walk in the park and the fee should be small. If it's complicated, sometimes the other side or our client who's unreasonable and doesn't understand what they're getting into in the first instant makes it more expensive. Unfortunately, lawyers by and large still function with the rate times time model, which is, doesn't have a lot, the theory being that if we spend time on it, we're adding value. Not a good theory, but it's the one we operate with.
Taking value.
Yeah, well, yeah, I mean, they try to add value. I mean, you already said if you screw it up, it's a mess and you pay for it later. So it's a bit about like the Fram commercial, you pay me now, you pay me later. But nobody should be shy about saying, what deal can you cut me? But also, to your point, care about who your partner is, because having a good counsel who'll be there, who can do quality work matters, just like having the right
100%
partner.
agree.
Okay, so it's not a time to be penny wise, pound foolish, but it's also not a time to just say, oh, whatever, okay. I mean, because most people can be flexible. If they think you have potential, they'll try to be really flexible, because my definition of a successful corporate lawyer is a corporate lawyer with successful clients. And most smart lawyers think that way. Absolutely. I'll add you one more thing, which just the word to the wise, which is if you go to a, international firm like Cooley, who I've worked with and they're wonderful lawyers, you often get a very junior person putting together some very basic documents. They don't know exactly what they're doing. They're being trained on your dime. So there's not a one size fits all. Every situation is somewhat different. You're absolutely right. There are some very small firms who charge, as I say, a lower hourly rate, and they know what they're doing and they can do it in a far more reasonable price tag.
Also true of accountants, by the way, right? So they will have
It's
people.
true of any service provider.
Right. So, I've always had an accounting firm where I knew the person who was doing the work, right? And I would rather pay a little bit more for that. I mean, you end up paying a lot more when you go to a big firm that's going to have a very junior person doing your work anyway. So like everything else, it's doing your homework.
And accountants are a bargain compared to attorneys. So, no, I didn't say that. Watching the time, it's 6:52. So do we have last question from the audience? Sir, you've had your hand up all night. Yes. I guess it's at what point is too small? Like before you walk in the room with them, is it okay to walk in the room and say, hey, I'm an LLC and I want to do an investment and I'm open to doing what needs to be done to do the investment? Or should I just do it first and assume that this is what they want? Is that, don't do it first. Is that kind of what the question is? Don't do any of that. As the accountant, I would tell you, and I'm sure all the attorneys would say, talk to the investor first because the investors will tell you what they're interested in and what they want. Some angels definitely would, because you talked about the tax benefit. I guess, before we wrap up the panel, I want to give the panelists quick 30 seconds, final thoughts, anything you'd love the audience to know, that's on your mind about finding funds or entrepreneurs, going out and starting a company. Lauren looks like he's thinking.
So definitely start a company. And the business plan contest is a great place to go out and trot out your idea and see how you do. These guys are judges. You can meet a lot of people. You're going to end up iterating on these things, and you might just win 50K plus $100,000 of prizes. So your idea needs to get out there. It needs to find other people. It shouldn't be a secret. It should be something that you talk a lot about.
So I've come to the conclusion over the years that the second most important thing, the most important thing is integrity. Second most important thing is domain expertise. So it's great to have a terrific idea and go out and build an app that you think the world wants. And then you find out they do want it, but now you have to figure out how to monetize that. So if you work in a business or an industry and you see a need, think about the company that you can start to fill that need in the industry where you already work, where you already know people, where you already have credibility, where you know where the bodies are buried. That's the biggest difference. That's the biggest change that's happened from the time that I started my company. So I worked for somebody who did something in Boston and other markets around the country, and I tweaked it and improved it and brought it to Providence. And when I went to sell it to people, I said, well, see what these people are doing all over the country. You should be doing it too. And by the way, it was still really, really hard. And I almost went out of business a couple of times. So, but that's a whole different thing from, creating something out of thin air that you think might be a good idea. Now, a lot of wonderful things have happened that way. I'm not discouraging you from that. I'm just saying that I think, if you don't have domain expertise in the area that you want to pursue, find somebody who does, because you don't know what you don't know. And that ends up sometimes causing a lot of pain.
Yeah, no, thanks for having me. And I would say that, Providence is a small ecosystem. I think we all have to work together and help each other grow each other's businesses. And I've always found when I give more, I receive way more. So my only thought is, when ecosystems are small, let's not compete. Let's help each other grow and be successful. And that's going to return massive, massive dividends in places. Come here to RiHub and CIC and work with these great service partners and work with folks with us. We might not write checks, but we're here to help you grow and be successful and help our portfolio companies. And, at the end of the day, if I'm a better contributor to society because of all the work I can do with you, it's been a pretty good day.
Thank you. The interesting thing, as you said, is Rhode Island is a very small institutional state, and you can meet all the key people you need to meet very quickly. We're not fragmented like the big states, and we have three pretty amazing people on our panel tonight that are here in Rhode Island. So I'd like to thank David Hemenway, president of the Angel Nest, Thorne Sparkman, managing director of Slater Technology Fund, and Tom Sperry, the co-founder and managing director of Rogue Venture Partners. As I said earlier, applications are being accepted. Deadline is March 27th at 5 p.m. Our award ceremony will be on May